Hi, folks. Stock markets have fallen, and mutual fund investors might be seeing that their portfolio is no longer giving those high returns which were coming earlier. If you were an SIP investor and you started fairly recently, that is in 2023 or so, then you would have been flexing till about September 2024 and showing people that your returns have been 3 to 4 times that of FD returns. But after September 2024, the stock markets have declined and people are seeing either a negative return or a 0% kind of return from their mutual fund holdings. Is this good or bad? When markets move upwards, every SIP investment that we are doing, we are purchasing at higher prices, so we are getting lesser units. So when the markets decline, it means that we are getting more units for the same amount that we are investing. This brings down our average cost price. This is important for investors to understand because when you're in the accumulation phase or the investing phase, then it is okay for markets to move downwards because you are accumulating more units. It's only the redemption phase that you want the markets to be at peak so that you get maximum returns out of your investments. So you can continue your SIP investments if you have a long time horizon and you are not looking for a redemption in the next few months or years. Now, if you have a lump sum to invest, this could be a good time. This is because all the indices have fallen across categories. If you look at the Nifty 50 from the high of September 2024, it has declined by about 14%. The mid cap indices have declined by about 17%. Small cap indices have declined by about 22%. And the Nifty Next 50 has been hit the hardest by about 23%. So while we don't know if the market bottom has been found or is it going to fall further, but if you consider that this is a good entry point, that prices have fallen significantly and is a good entry point, you can start putting in money via the lump sum route to reduce your average cost price. Now, the strategy I'm following is that yes, I'm entering at this point of time, but I'm not putting all my money. So let's say that I have 1 lakh rupees to invest. I've only put in 25% right now. I've recorded the NAVs which I put in at across different categories of funds. And I've also calculated what would be a 5% fall from those NAVs. If the NAVs broadly fall by 5%, then I'm planning to bring in the next 25% or the next 25,000 rupees. And how have I done the split? I maintain the same split as my current allocation to funds. So let's say that I'm 50% allocated to large cap oriented funds, 30% to mid cap oriented funds, and 10% to small cap oriented funds. I'm following the same allocation. The balance 10%, which is allocated to US tech funds, I'm not putting any more money in because US markets are at a high. I don't want to enter in via the lump sum route at this point of time. So you see, my strategy is in place. I'm not going to react when markets are going to fall, wondering what to do at that time. As when markets fall and reach the desired levels of NAV on my funds, I'm going to deploy the next 25%, which is there, and so on and so forth. Now, I don't know if markets are likely to keep on falling further or not. So I may have to tweak my strategy a bit if it hits a plateau after a while. But if it does not, then I can follow this strategy. As an investor, you may want to take up a different strategy, saying that you may enter it with 10% at this point of time, 20% after, 30% after that, and 40%, and set the strategy in that order. That's up to you. It depends on your goals and your amounts and your risk appetites. Now, where can you hold this corpus, that is this 1 lakh or whatever amount that you're targeting? So if you hold it in your savings account, it is likely that part of it may dribble away. Some expenses will come up and we may end up spending on that. So you can hold this in the respective fund houses liquid funds. So if you're investing in, let's say, the Motilal Nifty 50 fund, then you can hold it in the Motilal liquid fund. If you're putting it in a Parag Parikh flexi fund, you can hold the money into Parag Parikh liquid fund. When markets drop, you can do a switch out to the target fund. Now, it is important to also understand that the Indian stock markets have had a solid run from 2020 June or July onwards till September 2024, it was a fantastic bull run. So it is likely that markets are going to take time to decline and then time to climb up again. So do not put money in to these funds if you need it in the next few years, be it your kids' fees or any major payments that you have kept money aside for. Do not invest this. You must have a 7+ years kind of horizon at least to enter in at this point of time. So I hope these pointers help you in your investment journey. If you have any queries, do drop a comment or contact us on our contact points, and we'll be happy to get back to you. Thanks for watching.